there's a number. A single, solitary figure buried deep within the financial statements of a company that holds the genetic code for explosive, life-changing stock returns. It's not the number the headlines scream about. It's not revenue growth. It's not the quarterly earnings per share that sends analysts into a frenzy. And it's not the famous P/E ratio that most of us are taught to look at first. This number is something quieter, something more profound. It's a measure not of size, but of quality, not of activity, but of intelligence. It is the single most powerful indicator of management skill and the most reliable predictor of long-term wealth creation. It's called return on invested capital, and understanding its awesome power is the final promise that separates the amateur speculator from the professional wealth builder. Most investors spend their lives skating on the surface, mesmerized by the illusion of growth. They see a company opening new stores, hiring thousands of employees, and announcing record-breaking sales, and they think, this is it, this is the winner. But what they fail to ask is the one question that matters above all others. What is the cost of that growth? Because some profits, some growth, actually destroy your money. They are a mirage. Imagine a company that spends $1 billion to build a new factory. That factory, after a year of hard work, generates $50 million in profit. The headlines will read, "New factory adds $50 million to bottom line." The stock might even go up, but you, armed with the knowledge you're about to receive, will see the truth. That company spent $1 billion of shareholder money to earn a paltry 5% return. You could have earned that in a safe government bond with zero risk. That company didn't create value. It took $1 of your capital and transformed it into 5 cents of annual profit, effectively incinerating the potential of that capital. Now imagine a different company, a software business that spends $1 million developing a new product. That product goes on to generate $5 million in profit, year after year, with almost no additional investment. That is a return of 500%. That is the engine of 100x stock returns. That is the magic we are here to uncover. The journey we are about to embark on is a deep dive into the mind of Warren Buffett, not just to revere his folksy wisdom, but to steal his single greatest analytical tool. This tool will allow you to bypass the 99% of stocks that are capital-destroying treadmills and identify the 1% that are true compounding machines. You will learn to see a business not as a ticker symbol, but as a living entity that either intelligently reinvests its earnings to create a tidal wave of future value, or foolishly squanders them on projects that erode your investment. This is the ultimate key to portfolio growth, to achieving genuine financial freedom, and to building the kind of long-term wealth that transforms lives. This is the difference between simply investing and achieving mastery. The story begins not in a sleek Wall Street boardroom, but in a world of chocolate and caramel, a world of old-fashioned values and even older-fashioned recipes. In 1972, Warren Buffett and his partner Charlie Munger were presented with an opportunity that would forever alter their investment philosophy and, by extension, the entire landscape of modern value investing. They were offered the chance to buy a company called See's Candies. On the surface, it was a simple, family-owned box chocolate company based in California. It was beloved by its customers, a regional icon. But to Buffett and Munger, who had built their fortunes on a strategy they called cigar butt investing, it looked horrifyingly expensive. Their method up to that point was to find wretched businesses trading for less than they were worth if you liquidated them. They'd buy a failing textile mill or a struggling department store for 50 cents on the dollar, wait for the market to realize it was worth maybe 60 cents, and sell for a small, quick profit. One last puff from a discarded cigar butt. It was ugly work, but it was profitable. See's Candies was the polar opposite. The See family wanted $25 million for the business. At the time, the company had about $8 million in tangible assets: the stores, the equipment, the inventory. Buffett's brain, conditioned by years of bargain hunting, saw a price that was more than 3 times the company's physical worth. It was an immediate, visceral no. He was being asked to pay $17 million for something he couldn't even see or touch. The brand, the customer loyalty, the simple idea of See's candies in the minds of Californians. To the cigar butt investor, this was madness. But Charlie Munger, the crucial intellectual partner in this story, saw something else. He saw a machine, a beautiful, perfect financial machine. He understood that See's had a secret power, a hidden moat that protected it from competition. Generations of Californians had given See's chocolates as gifts for birthdays, for Valentine's Day, for Christmas. When a young man went to meet his girlfriend's parents for the first time, he brought a box of See's. It wasn't just candy. It was a social lubricant, a symbol of good taste and affection. Because of this, See's had pricing power. Every year, they could raise the price of their chocolates just a little bit, and their loyal customers wouldn't even think of switching to a cheaper brand. This small act of raising prices, multiplied across millions of transactions, sent profits cascading directly to the bottom line. But that was only half of the magic. The other half was what the business didn't need. To grow, See's didn't need to build massive billion-dollar factories. It didn't need to spend hundreds of millions on research and development. It already had the recipes, it already had the brand. To open a new store was a relatively trivial capital expense. The business was, in Buffett's later words, a gusher. It produced enormous amounts of cash, far more than it needed to maintain its operations or to grow modestly. Munger pushed Buffett. He told him, "Warren, this is a different kind of business. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." That single sentence was the pivot point. It was the moment they transitioned from being mere bargain hunters to becoming long-term owners of exceptional businesses. Reluctantly, Buffett agreed. They paid the $25 million. That decision, born of Munger's insight and Buffett's reluctant agreement, became the cornerstone of the Berkshire Hathaway empire. Over the decades since that purchase, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that required almost no additional capital investment. That $25 million purchase price was returned many times over. That geyser of cash from See's became the seed capital for other acquisitions. The profits from chocolate boxes in California funded the purchase of insurance companies, railroads, and utilities. See's Candies was the engine that taught them the single most important lesson in their careers. The true measure of a business is not what it owns, but how much cash it can generate in relation to the capital tied up in it. That is the definition of a high return on invested capital. See's was a business that could take $1 of capital and, through the magic of its brand and pricing power, turn it into astounding levels of profit year after year, without demanding more capital. It was the perfect machine, and finding it changed everything. The decision to pay what seemed like a high price for See's Candies required Buffett and Munger to override a powerful set of cognitive biases that keep most investors trapped in mediocrity. The first and most prominent is what psychologists call anchoring bias. Buffett's entire career up to that point had been anchored to the concept of tangible book value. He was a student of Benjamin Graham, the father of value investing, whose entire system was built on buying stocks for less than their net current asset value. The number on the balance sheet for property, plant, and equipment was his anchor. The $25 million asking price for See's was so far above its tangible asset value of $8 million that his brain initially rejected it as irrational. He was anchored to the past, to a method that had worked but was ultimately limited. The 99% of investors live and die by this bias. They see a stock that has fallen 50% and think it must be cheap. They see a stock at an all-time high and think it must be expensive. They are anchored to a price, not to the underlying value of the business machine itself. The second bias they had to conquer was the scarcity heuristic. This is our mental shortcut that equates scarcity with value. In cigar butt investing, the opportunities were scarce. You had to dig through thousands of obscure, failing companies to find one that was mispriced. The difficulty of the search reinforced the idea that the prize was valuable. See's Candies, by contrast, was not a secret. It was a well-known, successful company. It didn't feel like a hidden gem. Paying up for quality feels easy, and our brains are suspicious of easy wins. We equate effort with reward. This is why many investors would rather spend 100 hours searching for a mediocre company trading at a 20% discount than spend 10 hours analyzing a wonderful company trading at a fair price. The intellectual struggle feels more rewarding, even if the financial outcome is inferior. Finally, they had to overcome a subtle form of loss aversion. Paying a premium for an intangible asset like a brand feels risky. What if the brand fades? What if a new competitor emerges? The $17 million they were paying for goodwill felt like vapor, something that could disappear overnight. The $8 million intangible assets felt real, solid. If the business failed, they could at least sell the stores and equipment. This fear of losing the premium payment is a powerful deterrent. It's why so many investors prefer businesses with hard assets, like manufacturing or real estate, over businesses with intangible assets, like software or branding, even when the latter generate far higher returns on capital. Munger's genius was in reframing the problem. He forced Buffett to see that the real risk was not in paying for the brand. The real risk was in Tonoppo owning a business of such immense quality. The risk of permanent capital loss was actually far lower with a dominant, beloved brand like See's than with a struggling textile mill, regardless of the purchase price. By understanding the deep psychological moat created by customer loyalty, he saw that the intangible asset was actually safer and more durable than the tangible ones. Overcoming these biases was the true breakthrough. It allowed them to move beyond the simple arithmetic of the balance sheet and into the more complex but far more lucrative calculus of business quality and long-term shareholder value. To apply the See's Candies lesson to your own investment strategy, you must adopt what can be called the wonderful business at a fair price blueprint. This is a mental model that shifts your focus from what a company is worth today if you liquidated it, to what it can become over the next decade if its internal compounding machine is left to run. It's a fundamental shift in perspective that is essential for identifying potential 100x stocks. Step 1 is to become a qualitative detective and identify a durable competitive advantage, what Buffett calls a moat. Forget the numbers for a moment. Ask yourself, what protects this company from competition? For See's, it was its brand and the ingrained customer habit. For other companies, it might be a patent, like a pharmaceutical company, a network effect, like a social media platform, high switching costs, like the enterprise software that runs a bank, or a low-cost advantage, like a massive retailer. You must be able to clearly articulate in a simple sentence why this business can fend off rivals for decades. If you can't, it doesn't have a moat, and you should move on. Step 2 is to analyze the company's capital needs. This is where you start connecting the qualitative story to the financial reality. A business with a great moat that requires enormous, constant reinvestment of capital is like a knight trying to defend a castle by constantly rebuilding its walls as they crumble. It can be done, but it's exhausting and expensive. You want a castle with walls so strong they require almost no maintenance. Look at the company's cash flow statement. Find the line item for capital expenditures. Compare this number to net income or cash flow from operations. In a business like See's or a modern equivalent like a dominant software company, capital expenditures will be a tiny fraction of the cash the business generates. In a capital-intensive business like an airline or an auto manufacturer, capital expenditures will consume a huge portion of that cash. Your goal is to find businesses that gush cash and require only a trickle of it to maintain and grow their operations. Step 3 is to perform a preliminary calculation of its return on capital. You don't need a complex model yet, a simple back-of-the-envelope check will do. Look at the company's pre-tax earnings and divide it by the sum of its long-term debt and its shareholders' equity. This gives you a rough idea of the return the business is generating on all the capital entrusted to it. Is that number consistently above 15%? 20%? The higher, the better. This is the horsepower of the compounding engine. A business earning 6% on its capital is a horse and buggy. A business earning 25% on its capital is a Formula One race car. Step 4 is the hardest part, for it requires emotional discipline. You must be willing to pay a fair, and sometimes what feels like a slightly high, price for true quality. After identifying a wonderful business with a durable moat, low capital needs, and a high return on capital, you will almost never find it trading at a dirt-cheap cigar butt price. The market is not that foolish. Your job is not to find a perfect company at a perfect price. Your job is to find a truly exceptional company at a price that does not preclude an excellent long-term return. This means accepting a P/E ratio of 20 or 25 if the business is growing and can reinvest its earnings at a very high rate. You are not buying the stock. You are becoming a part owner of an extraordinary business machine. This blueprint is a direct repudiation of short-term thinking and a full-throated embrace of long-term investing, focusing on the quality of the business as the primary driver of shareholder value. The path of the 99% of investors is a road paved with statistical bargains that lead to financial disappointment. It is the path of the cigar butt trap, the original strategy that Buffett himself had to unlearn. This approach is seductive because it feels clever and mathematically sound. It involves screening for stocks with low price-to-book ratios, low price-to-earnings ratios, and low price-to-sales ratios. The investor finds a company, often in a struggling industry, that looks cheap on paper. They buy it, thinking they have found a diamond in the rough. In reality, they have purchased a fair business at what they hope is a wonderful price, but the business itself is often fighting against them. Let's take the example of a struggling retail chain. A cigar butt investor might see that its stock is trading for less than the value of its real estate and inventory. They think, great, I have a margin of safety. Even if the business closes, I'll get my money back. But they ignore the dynamics of the business itself. The company is facing intense online competition, its brand is fading, and its stores are in undesirable locations. Every day, the management team has to wake up and fight a brutal, uphill battle just to stay afloat. They are forced into endless price wars, which crush their profit margins. They might try to grow by opening new stores, but they are expanding a flawed concept, pouring good money after bad. The business is a melting ice cube. The intrinsic value that looked so solid on the balance sheet yesterday is slowly eroding. The inventory has to be marked down to sell. The real estate loses value as the anchor tenants in the mall go bankrupt. The cigar butt investor might get one small puff if there's a temporary piece of good news, but the long-term trend is almost always down. This strategy fails for 3 fundamental reasons. First, it requires you to be right twice. You have to be right about the purchase price, and you have to be right about the timing of the sale. Since the underlying business is poor, you cannot hold it forever. You must sell it, hopefully to a more optimistic buyer, before its value erodes completely. This turns investing into a constant, high-stress game of churning your portfolio. Second, this strategy is not scalable. You can deploy a few thousand, maybe even a few $1,000,000, buying these tiny, obscure, struggling companies. But you cannot build a multi-billion-dollar portfolio like Berkshire Hathaway this way. There simply aren't enough cigar butts to go around, and trying to buy a significant stake in one would drive up the price and ruin the bargain. Finally, and most importantly, it completely misses the power of compounding. A cigar butt, by definition, has no long-term future. It is a one-time event. A wonderful business, like See's Candies, is a gift that keeps on giving. Its value grows year after year, powered by its internal economics. By focusing on the cheapness of the price tag, the cigar butt investor ignores the quality of the engine. They choose a broken-down car because it's cheap, while ignoring the brand-new sports car with a slightly higher sticker price. The path of the 99% is a path of constant effort, high stress, and ultimately, mediocre results, because it mistakes a low price for good value and ignores the single most important factor in long-term wealth creation: the quality of the business itself. The profound financial advantage of owning a See's Candies type business becomes crystal clear when you look at how it manifests on the financial statements, specifically the balance sheet and the cash flow statement. It creates a virtuous cycle of wealth creation that is mathematically unstoppable. Let's start with the balance sheet of a typical low-return, capital-intensive company like an airline. On the assets side, you will see a massive number for property, plant, and equipment, PP&E. This represents their fleet of airplanes, which are incredibly expensive and constantly need to be maintained and replaced. This huge asset base is financed by a large amount of debt and equity on the other side of the balance sheet. Now look at the balance sheet of a business like See's Candies, or its modern equivalent, Moody's, the credit rating agency that Buffett also loves. The line for PP&E is minuscule in comparison to their profits. Their primary asset is not physical, it is intangible. It's the goodwill or brand value line item. This intangible asset requires almost no cash to maintain, yet it is the source of all the company's pricing power and profitability. Now let's turn to the cash flow statement, which tells the story of how cash moves through the business over a year. For the airline, the cash flow from operations might look healthy. They sell a lot of tickets. But then you look further down and see a gigantic negative number for capital expenditures, the money spent on new planes and maintenance. The free cash flow, which is operating cash flow minus capital expenditures, is often tiny or even negative. All the cash the business generated was immediately consumed just to stay in the game. They are on a treadmill, running as fast as they can just to stay in the same place. For the high-return business like See's, the story is the complete opposite. They generate strong cash flow from operations. But when you look down at capital expenditures, the number is incredibly small. They just don't need to spend much. The result is a massive amount of free cash flow. This free cash flow is the holy grail of investing. It is the money left over after all the bills are paid and all necessary reinvestments in the business have been made. This is the pot of gold that management can use to create shareholder value. They can use it to pay dividends, buy back stock, or, most powerfully, acquire other wonderful businesses. The See's Candies acquisition, which cost Berkshire $25 million in 1972, quickly began generating millions in free cash flow every year. That cash was then taken out of See's and used by Buffett to buy stakes in companies like Coca-Cola and American Express. The direct financial connection is this. A high return on invested capital business is a cash machine that funds its own growth with ease and then provides a surplus of capital for its owners to allocate elsewhere. A low return on capital business is a cash incinerator. It consumes vast amounts of capital just to stand still, let alone grow. By learning to read the financial statements through this lens, you can spot the difference between a business that will enrich you as an owner and one that will slowly but surely drain your capital away. Many investors and even many corporate executives are dangerously mesmerized by the siren song of growth. They see revenue climbing, market share expanding, and the company's name appearing in headlines, and they automatically assume that value is being created. This is one of the most pervasive and costly fallacies in the entire world of finance and business. The hard truth is that growth, in and of itself, is not always good. Growth only creates value when a company can invest capital at a rate of return that is higher than its cost of capital. When it invests at a return below that cost, growth actually destroys value. And no industry illustrates this painful lesson better than the history of the United States airline industry. For decades, the airline industry experienced phenomenal growth. From the dawn of the jet age, the number of passengers, the number of miles flown, and the total revenues of the industry grew at a spectacular pace. It was a story of constant expansion, new routes, bigger planes, and ever-increasing scale. If you were an investor who only looked at top-line growth, you would have been convinced that this was the place to put your money. But beneath this surface of exciting growth, a brutal economic reality was at play. The industry was characterized by vicious competition. Every time one airline found a profitable route, a half-dozen others would jump in, slashing prices to gain market share, turning a once lucrative opportunity into a bloodbath of losses. Furthermore, the business is astronomically capital-intensive. An airplane costs hundreds of millions of dollars. Maintaining a fleet requires a constant, massive outflow of cash. The unions are powerful, and fuel costs are volatile and unpredictable. The combination of these factors meant that despite the fantastic growth in revenues, the industry as a whole consistently earned a return on its invested capital that was far below its cost of capital. For decades, the cumulative earnings of the entire U.S. airline industry were less than zero. Think about that. All the investment, all the innovation, all the growth, from the Wright brothers to the jumbo jet, had produced a net loss for its owners. They were pouring billions upon billions of dollars of investor capital into a machine that systematically destroyed it. Even Warren Buffett, one of the most brilliant investors in history, fell victim to this fallacy. In 1989, he invested $358 million in preferred stock of U.S. Airways. He was attracted by the high dividend and what he thought was a temporary downturn. But he underestimated the truly terrible economics of the industry. He was investing in a company that was on a capital-intensive treadmill to nowhere. The investment quickly soured, and he spent years trying to extricate himself from it. He later famously joked, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his descendants a lot of money. This story serves as the ultimate cautionary tale. Growth without profitability at a high rate of return is a cancer on shareholder value. It consumes capital and gives back less than it takes. The market often rewards this kind of growth in the short term, but over the long term, economic gravity always reasserts itself, and the stocks of these capital-destroying growers ultimately go nowhere. The reason so many companies and investors fall into the growth trap is rooted in a pair of powerful cognitive biases: the narrative fallacy and action bias. The human brain is not a machine for processing spreadsheets. It is a machine for processing stories, and the story of growth is one of the most compelling narratives there is. A CEO who can stand up in front of investors and talk about opening 100 new stores, launching in a new country, or acquiring a major competitor is telling a story of progress, ambition, and conquest. This narrative is simple, exciting, and easy to understand. We are evolutionarily wired to respond to stories of expansion and dominance. The narrative fallacy, a term coined by Nassim Nicholas Taleb, describes our tendency to create and believe these simple stories to explain complex realities. We see revenue growth, and we create a story that says this company is winning. We ignore the messy, complicated details hidden in the cash flow statement that might tell a different story, a story of profitless growth and capital destruction. The financial media perpetuates this fallacy because stories about growth get more clicks and views than nuanced analyses of return on invested capital. Company X announces record sales is a much better headline than Company X's return on capital declines to 6%. Closely related to this is action bias. This is our innate psychological preference for action over inaction, even when inaction is the more rational choice. We feel that doing something is better than doing nothing. A CEO who is sitting on a large pile of cash faces immense pressure from the board, from shareholders, and from their own ego to do something with it. Making a big acquisition or launching a major capital expenditure project is visible, decisive action. It signals leadership. Quietly and patiently waiting for a truly high return opportunity, or even returning the cash to shareholders if no such opportunities exist, can be perceived as passive or lacking vision. This bias leads to a flurry of activity, much of it value-destroying. Companies make acquisitions at inflated prices just to keep the growth narrative alive. They pour money into projects with questionable returns because the alternative, doing nothing, feels like failure. As investors, we suffer from the same bias. We feel the need to be constantly trading, constantly looking for the next big thing. It's hard to sit still and let a wonderful business compound your wealth for a decade. The constant noise of the market encourages action, even when the best course of action is to simply let your high-quality businesses do their work. The combination of our love for simple growth stories and our bias for action creates a dangerous cocktail. It causes executives to pursue growth at any cost and investors to reward them for it, at least in the short term. Breaking free from these biases requires a conscious effort to prioritize the boring, unsexy mathematics of capital returns over the exciting but often misleading narratives of growth. To protect yourself from the allure of value-destroying growth, you need a practical mental model to stress test a company's expansion plans. This model is called the treadmill test, and it's designed to reveal whether a company's growth is creating value or simply burning through capital just to keep up. It's a way to look past the headlines and diagnose the true health of the business engine. Step 1 is to look at the historical relationship between growth and capital. Go to a financial data provider and pull up a company's financial statements for the last 5 to 10 years. First, find the annual revenue. Calculate the total dollar amount of revenue growth over that period. For example, if a company's revenue went from $10 billion to $15 billion over 5 years, the total revenue growth is $5 billion. This is the benefit of their growth activities. Step 2 is to calculate the total capital that was invested to achieve that growth. This is the cost. The simplest way to estimate this is to look at the retained earnings line on the balance sheet. Retained earnings are the cumulative profits that the company has not paid out as dividends. It is the capital that management has chosen to reinvest back into the business. Find the increase in retained earnings over that same 5-year period. For instance, if retained earnings grew from $4 billion to $9 billion, the company retained and reinvested $5 billion of profit. Step 3 is to compare the cost and the benefit. In our example, the company retained $5 billion of earnings to produce an additional $5 billion of annual revenue. This is just the first layer. The more crucial question is, how much profit did that new revenue bring? Let's say that new $5 billion in revenue came with a 10% profit margin, meaning it generated $500 million in additional annual profit. The company spent $5 billion of shareholder capital to get an additional $500 million in profit. That represents a 10% return on that incremental invested capital. This is the number that tells you if they are on a treadmill. If the company's cost of capital is, say, 8%, then a 10% return is creating some value, but not a lot. If the return on that new investment was only 5%, the company would be actively destroying shareholder value with every dollar it reinvests. They are on a treadmill, running hard, burning cash, and making their owners poorer. Step 4 is to ask the ultimate clarifying question. If this company stopped all of its growth projects today and decided to just run its existing operations, how much cash would it generate and what would it be worth? This thought experiment forces you to separate the core, profitable business from the potentially value-destroying growth initiatives. For a company like the airline, if it stopped buying new planes, it might suddenly generate a lot of free cash flow for a few years, but its business would quickly become uncompetitive as its fleet aged. For a company that is pursuing bad acquisitions, stopping that activity would reveal a highly profitable core business underneath and would be a huge positive for shareholders. The treadmill test is your defense against the narrative of growth. It's a quantitative tool that forces you to act like a business owner, not a speculator, and ask the most important question of all. For every dollar of my money that you keep, how many new dollars of profit are you creating for me in return? The antithesis of the treadmill test is the path walked by the 99% of investors, chasing revenue growth at all costs. This is an approach fueled by market excitement, media hype, and a fundamental misunderstanding of what drives long-term shareholder value. These investors operate under the deeply flawed assumption that a company getting bigger is the same as a company getting better. They are drawn to headlines and press releases, and they often become the last buyers at the peak of a cycle, right before economic reality sets in. Consider the classic example of a hot retail company. It develops a new, trendy concept, and the initial stores are wildly successful. The media latches on, Wall Street analysts issue glowing reports, and the stock price soars. The management team, celebrated as geniuses, announces an aggressive national expansion plan. They will open hundreds of new stores in the next 3 years. Investors who chase this story look only at the projected revenue growth. They see a chart going up and to the right, and they pile in. What they fail to do is look at the unit economics. The first few stores were in prime, high-traffic locations. The 100th store might be in a less desirable suburban strip mall. The 200th store might be in a market that is already saturated with competitors. The returns on the capital invested in these new stores get progressively lower and lower. The company is forced to spend more on marketing to drive traffic to these inferior locations. The overall return on invested capital for the company as a whole begins to decline. The company is getting bigger, but the quality of the business is getting worse. On the financial statements, revenue is climbing, but debt is also climbing to fund the expansion. Free cash flow is negative because all the cash from operations is being plowed back into new store build-outs. The investor chasing the growth story sees none of this. They only see the top line. Then, one day, the company misses its quarterly earnings estimate. The growth story sputters. The market, which had priced the stock for perfection, is shocked. The narrative shatters, and the stock price can collapse by 50% or more in a single day. Another common trap is the growth by acquisition story. A company, often with a slow-growing core business, starts buying other companies to create the illusion of dynamism. The CEO is praised for being a bold dealmaker. The revenues of the combined entity are, by definition, larger. But the investor chasing this story rarely asks if the company overpaid for the acquisition, or if the acquired business is even a good one. More often than not, these acquisitions are made at the peak of the market, for huge premiums, and the promised synergies never materialize. The acquiring company has simply bought expensive, low-return revenue. This is a fast track to destroying shareholder value, yet it happens every single day, and investors who don't look past the headlines fall for it every time. The path of the 99% is a reactive one. It is driven by emotion and narrative. It confuses activity with progress and size with value. It is the path of buying high and selling low, of getting caught up in bubbles and panicking in crashes. It is the polar opposite of the disciplined, business-like approach of measuring the return on every dollar of invested capital. The difference between value-creating growth and value-destroying growth is not just a theoretical concept. It is a story told in hard numbers on a company's cash flow statement. This financial document is the ultimate lie detector. It cannot be as easily manipulated with accounting tricks as the income statement, because it tracks one thing and one thing only: the movement of actual cash. By learning to read it correctly, you can see with perfect clarity whether a company is a compounding machine or a capital incinerator. The cash flow statement is broken into 3 sections. The first, cash flow from operations, shows the cash generated by the company's core business activities. For a healthy company, this number should be strong and consistently positive. This is the raw fuel for the engine. But this is where most investors stop looking. The crucial information lies in the next section, cash flow from investing. This section shows where the company is spending its money on long-term assets. The most important line item here is capital expenditures, or CapEx. This is the money spent on things like new factories, new equipment, and upgrading technology. It is the cost of maintaining and growing the business. A company engaged in value-destroying growth will have a cash flow statement that tells a very specific story. It will show a healthy cash flow from operations, but then an enormous negative number for capital expenditures that consumes all, or even more than all, of the operating cash flow. The result is that the company's free cash flow, which is simply operating cash flow minus CapEx, is consistently weak, zero, or negative. The business is a black hole for cash. It is taking all the money it makes from its customers and pouring it into new projects that may or may not generate a decent return in the future. The airline industry is the classic example. A successful year of selling tickets might generate billions in operating cash flow, but the purchase of a few dozen new airplanes will consume all of that cash and more. They are constantly reinvesting 100% of their profits just to stay competitive, with very little left over for the owners. Now contrast this with a value-creating grower. This company will also show strong cash flow from operations. But when you look at its capital expenditures, the number will be relatively small. The business is capital light. It doesn't need to spend massive sums to grow. As a result, it generates enormous and growing free cash flow. This is the surplus cash, the owner's earnings, the real profit. This is the cash that can be used to create immense shareholder value. A company like this can pay a dividend, it can smartly buy back its own shares when they are undervalued, or it can make intelligent, high-return acquisitions. This is the financial signature of a compounding machine. By making a simple comparison between cash flow from operations and capital expenditures over a 5-year period, you can cut through all the noise and all the narratives and answer the fundamental question: does this business produce cash for its owners, or does it consume it? The cash flow statement reveals the truth behind the growth story. It is the final arbiter, separating the companies that are making you rich from the ones that are running on a treadmill and slowly destroying the value of your capital. There is a role in the corporate world that is more important than that of the chief marketing officer, the head of engineering, or even the chief operating officer. It is a role that is rarely discussed on business news channels and is almost never mentioned in a company's product advertisements. Yet it is the single most important determinant of a company's long-term success or failure. That role is the CEO as chief capital allocator. A CEO has 5 basic choices for the capital the company generates. First, they can reinvest it back into the existing business. Second, they can acquire other businesses. Third, they can pay down debt. Fourth, they can pay a dividend to shareholders. And fifth, they can buy back the company's own stock. That's it. Those are the only 5 things they can do with the profits. The long-term financial results of the company will be determined almost entirely by the wisdom and discipline with which its CEO makes these 5 decisions over many years. And there is perhaps no greater master of the art of capital allocation in corporate history than Tom Murphy, the longtime CEO of Capital Cities, ABC. Warren Buffett has said of Murphy, "He is the best business manager I've ever met." This is not praise he offers lightly. Tom Murphy, along with his partner Dan Burke, built a media empire from a single, struggling television station in Albany, New York. Their story is a masterclass in intelligent capital allocation. Their strategy was deceptively simple. They would buy media properties, television stations, radio stations, and newspapers that were undermanaged or in out-of-favor markets. They were notoriously frugal, never overpaying for an acquisition. Once they owned a property, they would install one of their trusted managers, give them extreme autonomy to run the operations, but maintain strict central control over all major capital spending decisions. They ran their businesses with ruthless efficiency and a focus on generating the maximum amount of free cash flow. This is where their genius truly shined. They would take the gusher of cash produced by their existing stations and redeploy it to buy more properties, but only if those properties met their strict criteria for high returns on investment. They were patient. If no attractive opportunities were available, they would simply let the cash build up or buy back their own stock if it was cheap. They were not interested in growth for growth's sake. They were interested in intelligent, profitable growth. Their crowning achievement came in 1985, in a deal that stunned the business world. Capital Cities, which was a relatively small media company at the time, announced it was acquiring the American broadcasting company, ABC, a company nearly 4 times its size. It was a minnow swallowing a whale. Wall Street was skeptical. How could this small, frugal company possibly manage such a massive and iconic network? But Murphy and Burke applied their time-tested formula. They ruthlessly cut the corporate excess and bureaucracy that had plagued ABC. They decentralized decision-making. They focused every division on profitability and cash generation. The result was a spectacular success. The acquisition, which many thought would bankrupt them, turned into one of the most profitable media deals in history, creating billions of dollars in shareholder value. Tom Murphy's story teaches us that the core job of a CEO is not to be a visionary or a charismatic pitchman. The core job is to be a rational and disciplined investor of the shareholders' capital. A great operator, with a bad capital allocator at the helm, will, at best, produce mediocre results. A mediocre business with a brilliant capital allocator at the helm can become a compounding machine that creates legendary wealth. The reason that so many CEOs fail at their most important job of capital allocation can be largely explained by a concept from economics known as the principal agent problem. This problem arises when one person, the agent, in this case the CEO, is supposed to act in the best interests of another person, the principal, the shareholders, but is instead motivated by their own self-interest. The interests of CEOs and the interests of shareholders are not always aligned. In a perfectly rational world, a CEO's compensation and prestige would be tied directly to the long-term growth in the company's per-share intrinsic value. But in the real world, that's often not the case. A CEO's salary, bonus, and perhaps most importantly, their ego and public reputation are often tied to the sheer size of the company they manage. The CEO of a $50 billion company is generally paid more and gets more favorable press coverage than the CEO of a $10 billion company, even if the smaller company is far more profitable and generates much higher returns on its capital. This creates a powerful and often subconscious empire-building bias. CEOs are incentivized to grow the size of their empire, even if that growth comes at the expense of shareholder returns. This bias manifests in several destructive ways. It leads to a relentless focus on revenue growth over profitability. It encourages large, headline-grabbing acquisitions, which are often a faster way to increase the size of the company than patient, organic growth. The thrill of the deal, the adrenaline of the negotiation, and the laudatory articles in the business press that follow a major acquisition can be a powerful psychological cocktail for a CEO. They get to feel like a corporate conqueror. The problem is that these deals are often done at inflated prices, with overly optimistic projections of synergies that rarely come to pass. Another way this bias shows up is through a reluctance to shrink the company, even when it's the rational thing to do. A CEO might have a portfolio of businesses, some of which are high-return stars and others that are low-return dogs. The logical move would be to sell off the mediocre businesses, even at a loss, and reinvest the proceeds into the stronger divisions. But this would mean the overall company would get smaller, at least temporarily. The CEO's empire would shrink. This is often seen as a public admission of failure, so the CEO will hang on to the underperforming assets for far too long, allowing them to drag down the overall performance of the company. The principal agent problem is not necessarily about CEOs being bad people. It's about the incentive structures and psychological pressures of the job. They are surrounded by investment bankers who are paid massive fees to encourage deals, and by a board of directors that may be more focused on short-term stock performance than long-term value creation. Overcoming this deep-seated bias requires a rare combination of intellectual honesty, emotional discipline, and a genuine owner-like mentality. The CEOs who succeed are the ones who think of the company's money as their own, and who derive their satisfaction not from the size of their empire, but from the long-term returns they generate for their fellow shareholders. As an investor, you are a part owner of the businesses in your portfolio. That means the CEO works for you. It is your job to evaluate whether they are doing a good job as a steward of your capital. To do this, you need a practical tool, a shareholder-oriented CEO scorecard. This is a checklist of qualitative and quantitative measures that will help you separate the empire builders from the true value creators. The first and most important item on the scorecard is to read the CEO's annual letter to shareholders. Go back and read the last 5 to 10 years of them. Is the CEO being candid and transparent? Do they admit their mistakes? Or is every year a story of glorious, unmitigated success, glossing over any problems? More specifically, what metrics do they focus on? Does the CEO talk obsessively about revenue growth and adjusted EBITDA? Or do they discuss the key drivers of long-term value, like return on invested capital, free cash flow per share, and the economic moat of the business? A shareholder-oriented CEO educates their owners about the underlying economics of the business. An empire-building CEO tries to sell them a simplistic growth story. The second item is to analyze their track record of acquisitions. Don't just take their word for it that a deal was transformative. Do your own homework. What price did they pay? Look at the valuation multiples, like the price-to-sales or price-to-earnings ratio, and compare them to similar deals in the industry. Did they pay a huge premium? Then, track the performance of the acquired business in the years following the deal. Did it deliver the growth and profitability that the CEO promised? Or was it quietly swept under the rug in a corporate restructuring a few years later? A history of overpaying for acquisitions is the single biggest red flag of a poor capital allocator. The third item is to scrutinize their share buyback history. Share buybacks can be a wonderfully tax-efficient way to return capital to shareholders, but only if they are done at the right price. A shareholder-oriented CEO will be opportunistic, buying back large amounts of stock when the company's share price is trading below its intrinsic value. This is an act that directly increases the per-share value for the remaining owners. A less skilled CEO will often do the opposite. They will buy back stock when the business is doing well and the share price is high, often to offset the dilution from their own stock option grants. They are buying high, which is a terrible use of your capital. The fourth and final item is to examine their overall capital structure and dividend policy. Is the company conservatively financed, with a strong balance sheet? Or is it loaded up with debt to fund risky acquisitions? Does their dividend policy make sense? A company in a mature, slow-growth industry should probably pay out a significant portion of its earnings as dividends. A company with a long runway of high-return reinvestment opportunities should retain most or all of its earnings to fund that growth. The policy should be thoughtful and consistent with the economics of the business. By using this four-part scorecard, you can move beyond the superficial analysis of a CEO's charisma or their latest media appearance. You can develop a clear-eyed, objective view of their skill as a capital allocator. Finding a company with a great business model is only half the battle. Finding one that is also run by a brilliant, shareholder-oriented capital allocator is how you find the true 100x stocks. The opposite of a masterful capital allocator like Tom Murphy is a figure all too common in the corporate world, the diversification CEO. This is the manager who takes a wonderful high-return core business, the corporate crown jewel, and uses the prodigious cash flow it generates to make a series of ill-advised acquisitions in mediocre or unrelated businesses. In the process, they dilute the overall quality of the company and destroy immense amounts of shareholder value. The term diversification was coined by the legendary investor Peter Lynch to describe this phenomenon. It is diversification for the sake of diversification, driven by the empire-building ego of the CEO rather than by sound business logic. The story often follows a predictable and tragic pattern. It begins with a company that has a fantastic core business with a deep competitive moat. It might be a dominant software product, a beloved consumer brand, or a patented medical device. This business is a cash machine. It earns very high returns on capital and doesn't require much reinvestment to maintain its dominance. As the cash pile on the balance sheet grows, the CEO starts to feel pressure. They believe the core market is maturing and that they need to find new avenues for growth. Instead of returning the excess cash to shareholders through dividends or buybacks, they decide to go shopping. Their first acquisition might be in a tangentially related field. It doesn't have the same great economics as the core business, but the CEO convinces the board that there are powerful synergies to be had. The deal is done, and the company's overall return on capital dips slightly. Then comes the second deal, and the third. The acquisitions get further and further afield from the company's core competency. A successful food company buys a chain of hotels. A profitable media company buys a manufacturing plant. The CEO starts talking about transforming the company into a diversified conglomerate. The problem is that the management team has no expertise in running these new businesses. They are competing against focused, experienced operators in those industries, and they are losing. The newly acquired businesses earn low returns, consume a lot of capital and management attention, and become a drag on the company's overall performance. The cash that used to flow from the crown jewel is now being siphoned off to prop up these struggling new divisions. The once simple, elegant, high-return business has become a complex, bureaucratic, low-return mess. For investors, this process is excruciating. They watch as the quality of the company they own deteriorates quarter by quarter. The stock price stagnates or declines, even as the original core business continues to perform well. The diversification CEO has taken a winning formula and destroyed it through a misguided attempt to build an empire. This is why, as an investor, you must be ever vigilant. When a company with a great business starts making acquisitions outside of its circle of competence, it is often a signal to sell. It is a sign that the CEO has forgotten their primary job: to be a disciplined steward of shareholder capital, not a collector of corporate assets. One of Warren Buffett's most powerful, yet simple, mental models for measuring the effectiveness of a capital allocator is something he calls the, quote, $1 test. It's a direct, quantitative way to see if a CEO is creating or destroying value with the profits they choose to retain in the business. The logic is simple and undeniable. A company's stock market valuation should, over time, increase by at least $1 for every dollar of earnings that is retained and reinvested in the business. If it does, management has created value. If it fails to do so, management has destroyed value. Here's how to apply the test. First, you need to look at a company's financial statements over a significant period, say 10 years. Go to the balance sheet and find the line for retained earnings. Calculate the total increase in retained earnings over that 10-year period. Let's say it went from $2 billion to $7 billion. That means the company has retained a total of $5 billion of its profits over the decade. This is the amount of shareholder capital that management has been entrusted to reinvest. Next, you need to look at the company's market capitalization, which is simply its stock price multiplied by the number of shares outstanding. Find the market cap at the beginning and the end of that same 10-year period. Let's say the market cap went from $10 billion to $18 billion, an increase of $8 billion. Now you compare the two figures. In this case, for the $5 billion of earnings that were retained, the market value of the company increased by $8 billion. That means that for every $1 of retained capital, management created $1.60, $8 billion per $5 billion, in market value for its owners. This CEO passes the test with flying colors. They have proven their ability to invest capital at high rates of return, and shareholders have been handsomely rewarded for it. Now consider the alternative. Imagine another company also retained $5 billion over 10 years. But its market capitalization only went from $10 billion to $12 billion, an increase of just $2 billion. For every $1 of retained capital, management created only 40 cents, $2 billion per $5 billion of market value. This CEO has failed the $1 test miserably. They have taken $1 of your money and turned it into 40 cents. The shareholders would have been far better off if the company had simply paid out all of its earnings as dividends, allowing the shareholders to reinvest the money themselves. This simple test cuts through all the corporate jargon and CEO promises. It is a direct, historical audit of management's performance. It is the ultimate measure of shareholder value creation. While it's not a perfect predictor of the future, a long track record of passing the $1 test is one of the most reliable indicators you can find of a high-quality management team and a business with a durable competitive advantage. It is the financial proof that the company is not just growing, but is intelligently compounding your capital. At the very heart of long-term investing, beyond the stories and the personalities, lies a force of nature so powerful that it has been called the eighth wonder of the world. That force is compounding, and the engine of compounding within a business is the virtuous cycle created by reinvesting profits at a high rate of return. This is the flywheel that, once it gets spinning, can create almost unstoppable momentum and drive the kind of 100x stock returns that build legendary fortunes. To truly understand this, we need to look at a modern master of this process, the Canadian company Constellation Software, and its brilliant, reclusive founder, Mark Leonard. Leonard, a former venture capitalist, started Constellation with a simple but powerful idea. He would acquire small, niche, vertical market software, VMS companies. These are the software businesses that provide essential, mission-critical services for very specific industries. Think software for managing a network of dental clinics, or a system for running a spa, or software for a public transit authority. These small VMS businesses share several wonderful economic characteristics. They have very high switching costs. Once a dental clinic has all of its patient records, billing, and scheduling on a particular software, the cost, risk, and headache of switching to a competitor is enormous. This gives the software provider pricing power. They are also capital light. Once the software is developed, the cost of selling an additional copy is close to zero. And because they operate in small niche markets, they often face little to no effective competition. As a result, these businesses generate very high returns on invested capital. Leonard's genius was in creating a system to acquire these businesses and then let them operate autonomously, while he and his team at the head office focused on one thing: capital allocation. Constellation Software generates a tremendous amount of free cash flow from its existing portfolio of hundreds of VMS businesses. Leonard's team then takes that cash and relentlessly scours the globe for more small VMS companies to acquire, but only if they meet their strict, non-negotiable criteria for business quality and valuation. They are disciplined buyers. This process has created a magnificent compounding flywheel. In year one, their portfolio of businesses generates, say, $100 million in free cash flow. They reinvest that $100 million to buy new businesses. In year two, their original portfolio plus the newly acquired businesses generates $120 million in free cash flow. They now have even more capital to reinvest. This creates an accelerating loop. High returns generate a lot of cash. That cash is reinvested at high returns, which generates even more cash, which can then be reinvested again. The result of this relentless focus on compounding capital at high rates has been one of the most spectacular stock market performances of the 21st century. An investment in Constellation Software at its IPO in 2006 would have multiplied over 100 times, creating life-changing wealth for its long-term shareholders. This is not a story of a revolutionary new technology or a hot consumer trend. It is a story of disciplined execution, brilliant capital allocation, and a deep, profound understanding of the power of the compounding flywheel. It is the perfect illustration of our central thesis: the ability to consistently reinvest profits at high rates of return is the single most powerful engine of long-term value creation. The reason that so few investors fully grasp the explosive potential of a company like Constellation Software is due to a fundamental limitation in human cognition that psychologists call exponential growth bias. Our brains evolved in a world where most things were linear. If you walk for an hour, you cover a certain distance. If you walk for 2 hours, you cover twice that distance. Our intuition is naturally geared to think in straight lines. We are notoriously bad at intuitively understanding exponential growth, where the rate of growth is proportional to the current amount. The classic illustration of this is the riddle of the chessboard. If you place 1 grain of rice on the first square of a chessboard, 2 on the second, 4 on the third, and so on, doubling the amount for each of the 64 squares, how much rice will be on the final square? Our linear brain thinks it will be a large number, but manageable. The actual answer is a number so vast, over 9 quintillion grains, that it is more rice than has ever been produced in the history of the world. The growth is imperceptible at first, but in the later stages it becomes an avalanche. This is precisely how a compounding machine works in the stock market. A company that can consistently grow its earnings at, say, 20% per year, does not feel spectacular in the early years. The stock might perform well, but it won't be the hottest name on the market. Most investors, with their linear thinking, will overlook it in favor of companies with more dramatic, but often less sustainable, growth stories. They fail to project what that 20% annual growth will become in a decade or two. A company whose earnings grow at 20% per year will see those earnings multiply by nearly 6 times in 10 years. In 20 years, they will multiply by over 38 times. The value of the business and its stock price will inevitably follow. This cognitive blind spot is an advantage for the patient, long-term investor. It is the reason why truly great businesses can often be purchased at reasonable prices, especially in their earlier stages. The market as a whole systematically undervalues the durability and power of consistent high-return compounding. It is too focused on the next quarter, the next year. It cannot see the avalanche of value that is building on the second half of the chessboard. By training yourself to think exponentially, to truly internalize the mathematics of compounding, you gain a significant edge. You learn to appreciate the immense value of a business that can retain a large portion of its earnings and reinvest them at a 20 or 30% rate of return. You realize that this is the secret sauce, the recipe for generating the kind of wealth that is not just incremental, but transformational. You stop looking for short-term trades and start searching for long-term partners in compounding. To harness the power of compounding in your own portfolio, you need a practical mental model that translates the theory into a concrete investment process. This model can be called the owner's earnings compounding calculator. It's not a complex spreadsheet, but a way of thinking about a business's future potential by focusing on the two variables that matter most: the amount of cash the business generates and the rate of return at which it can reinvest that cash. Step 1 is to calculate a company's owner's earnings. This is a concept popularized by Warren Buffett, and it's his version of free cash flow. A simple way to estimate it is to take the company's net income, add back non-cash charges like depreciation and amortization, which you can find on the cash flow statement, and then subtract the average annual amount of capital expenditures needed to maintain the business's current competitive position. This requires some judgment, but looking at the historical average is a good start. This figure represents the true, discretionary cash profit that belongs to the owners each year. Step 2 is to estimate what percentage of those owners' earnings can be profitably reinvested back into the business. Buffett calls this the reinvestment rate. Look at the company's history. How much of their earnings have they typically retained versus paid out as dividends? Does the company operate in a growing industry with many opportunities for expansion? Or is it in a mature market with few places to put new capital? A young, high-growth company might be able to reinvest 100% of its earnings. A mature utility company might only be able to reinvest 20%. Step 3 is to estimate the rate of return the company is likely to earn on that reinvested capital. This is where your analysis of the company's return on invested capital, ROIC, comes in. If a company has historically earned a 25% ROIC and has a strong competitive moat, it's reasonable to assume it can continue to invest new capital at a similar rate. Step 4 is to combine these variables to project the future growth of the company's earnings power. The formula is simple. Expected earnings growth equals reinvestment rate x return on invested capital. Let's take an example. A company generates $1 billion in owner's earnings. It has a policy of retaining 60% of its earnings to fund growth, a 60% reinvestment rate. Its historical ROIC is 20%. The expected growth rate of its owner's earnings is 60% times 20%, which equals 12% per year. This simple calculation is the engine of a long-term valuation. It tells you the intrinsic growth rate of the business machine. By focusing on this formula, you can ignore the short-term noise of the market. You can see that a company with a high ROIC but a low reinvestment rate might not grow very fast. Conversely, a company that reinvests a lot but at a low rate of return is a value destroyer. The magic happens when you find a company that can do both. Reinvest a large portion of its earnings at a very high rate of return. That is the mathematical formula for a 100x stock. The path of the 99% of investors when it comes to compounding often leads them directly into what can be called the dividend trap and the embrace of portfolio stagnation. This path is paved with good intentions. Many investors, particularly those nearing or in retirement, are taught to seek out stocks with high dividend yields. They are attracted by the promise of a steady, predictable income stream. While dividends can be a component of a sound investment strategy, an obsessive focus on high yields often leads investors to fundamentally misunderstand the engine of wealth creation. A dividend is a signal. When a company pays a large portion of its earnings out as a dividend, the management team is effectively sending a message to its shareholders. That message is, we have run out of high-return opportunities to reinvest this capital inside our own business. They are admitting that they cannot find a way to deploy that dollar of profit to create more than a dollar of future value, so they are returning it to you. For some businesses in mature, slow-growth industries, like a utility or a consumer staples company, this is the correct and responsible decision. But for an investor seeking explosive portfolio growth, this is the opposite of what you want. You are looking for companies that have a long runway of opportunities to reinvest capital at 20%, 30%, or even higher rates of return. Every dollar that a company like that pays out as a dividend is a tragic waste of compounding potential. It's like taking a magic seed that could grow into a giant beanstalk and choosing to eat it instead. Consider two companies. Company A is a utility that earns $1 billion and pays out $800 million as an 8% dividend. It retains only $200 million. Even if it can invest that $200 million at a respectable 10% return, its earnings will only grow by $20 million per year, a growth rate of 2%. The stock price will likely plod along, providing income but very little capital appreciation. Company B is a software company that also earns $1 billion. It pays no dividend. It retains all $1 billion and reinvests it at a 25% rate of return. Its earnings will grow by $250 million in the next year, a growth rate of 25%. Over a decade, the earnings power and likely the stock price of Company B will have left Company A in the dust. The investor in the dividend trap sees the 8% yield from Company A as safe and attractive. They see the 0% yield from Company B as speculative and risky. But the reality is that the slow erosion of purchasing power due to inflation makes Company A's stagnant business the riskier long-term proposition. The path of the 99% prioritizes the immediate gratification of a cash dividend payment over the delayed, but exponentially more powerful, gratification of long-term compounding. It leads to portfolios that generate income but fail to create real, life-changing wealth. The virtuous cycle of the compounding flywheel is not an abstract theory. It's a tangible process that leaves clear fingerprints all over a company's financial statements. By learning to trace this cycle, you can see the wealth creation engine at work year after year. It's a story told through the interplay of the income statement and the balance sheet. Let's trace one full rotation of the flywheel. It begins on the income statement. In year one, our high-quality company generates, let's say, $100 million in net income. This is the fruit of its past good decisions. Now, the capital allocation decision is made. The company decides to retain 80% of these profits to fund growth and pay out 20% as a dividend. So, $80 million is retained. This decision is reflected on the balance sheet. The retained earnings account, which is part of shareholders' equity, increases by $80 million. This represents the new capital that has been added to the business. At the same time, the company's cash on the asset side has increased by that same amount. Now, that $80 million is deployed. The management team invests it. This could be in the form of research and development for a new product, the acquisition of a smaller competitor, or building a new, more efficient distribution center. This investment will show up as an increase in assets on the balance sheet, perhaps goodwill if it was an acquisition, or property, plant, and equipment if it was a new facility. This completes the first rotation. Now the second rotation begins, and this is where the magic happens. We move into year two. Because the $80 million was invested at a high rate of return, let's assume a 25% ROIC. that new capital generates an additional $20 million in profit, 25% of $80 million. The company's original operations are also still humming along, so the net income in year 2 is now higher. It's not $100 million anymore. It might be $120 million. The engine is now bigger and more powerful. The company again decides to retain 80% of its profits, but 80% of $120 million is $96 million. They now have even more capital to reinvest than they did the year before. That $96 million is then invested at the same high 25% rate of return, which will add even more to the next year's profits. This is the virtuous cycle. Higher profits lead to more retained capital. More retained capital, when invested at high rates, leads to even higher profits. It creates an accelerating feedback loop. You can see this process by tracking the growth in shareholders' equity and the growth in net income per share over a 5 or 10-year period. In a great compounding machine, you will see both of these figures marching steadily upwards in lockstep. This is the financial DNA of wealth creation. It is the direct connection between a high return on capital, a disciplined reinvestment policy, and the explosive long-term growth in shareholder value. After all the theory, the stories, and the mental models, the journey must eventually lead to the practical, real-world task of finding these incredible businesses for yourself. This can feel like the most daunting part of the process. You are no longer just learning from the past, you are trying to predict the future. This is where you must become an investor, a financial detective, and use the tools at your disposal to X-ray a business and see its true underlying quality. To illustrate this, let's imagine a fictional but realistic story of an investor in the early 2000s. Let's call her Sarah. Sarah was a diligent retail investor who had just been through the dot-com bust and was determined to find a more durable way to invest in technology. She was faced with a choice between two giants of the era, Cisco Systems and Microsoft. At the time, Cisco was the darling of the market. It was the, quote, plumber of the internet, manufacturing the routers and switches that formed the backbone of the digital world. Its growth was explosive, and many analysts believed it was destined to become the world's most valuable company. Microsoft, on the other hand, was seen as a more mature, slightly stodgy giant, embroiled in antitrust lawsuits and facing questions about its future growth. On the surface, both looked like great technology companies. But Sarah decided to apply the lens of return on invested capital. She started with Cisco. She saw a business that, while growing fast, was fundamentally in the hardware business. To grow, it had to build factories, manage complex supply chains, and hold a lot of physical inventory. Every dollar of new revenue required a significant investment in new capital. Its business was competitive, and it was constantly spending huge sums on R&D just to keep up with rivals. While profitable, its return on the massive amount of capital it had to employ was good, but not spectacular. Then she turned her X-ray on Microsoft. She saw a fundamentally different business model. Microsoft's primary products were Windows and Office. Once the initial software code was written, the cost to produce an additional copy was virtually zero. They could sell millions of copies on CDs at the time for a few cents each. The business was almost purely intellectual capital, not physical capital. It had a deep moat, protected by the network effects of its operating system and the high switching costs for its Office suite. When she looked at the numbers, the difference was stark. Microsoft's return on invested capital was consistently astronomically high. It generated mountains of free cash flow with very little need for capital expenditures. By focusing on this single, powerful metric, Sarah would have been able to cut through the prevailing market narrative. She would have seen that while Cisco was a good company, Microsoft was a truly extraordinary one. She would have understood that Microsoft's capital-light model made it a far superior long-term compounding machine. An investor who chose Microsoft over Cisco in the early 2000s would have seen their investment grow many times over in the subsequent 2 decades, while Cisco's stock stagnated for much of that period. Sarah's story demonstrates that by using ROIC as your primary analytical tool, you can look past the hype and identify the true quality of a business's economic engine, giving you the conviction to make the kind of long-term investments that build lasting wealth. One of the biggest obstacles that prevents retail investors from using a powerful metric like return on invested capital is a pair of cognitive biases that thrive in the modern financial world: information overload and complexity bias. We live in an age of infinite financial data. With a few clicks, you can access dozens of financial ratios, hundreds of pages of company filings, and a constant stream of real-time news and analysis for any public company. This fire hose of information is overwhelming. Information overload leads to a state of analysis paralysis, where the investor feels so swamped by data that they are unable to make a clear decision. They don't know what to focus on, so they either give up and buy a simple index fund, or they latch on to the one or two simple metrics that the financial media talks about most, like the PE ratio. This is where complexity bias comes in. This is our tendency to believe that a complex solution is better than a simple one. In investing, this bias manifests as a reverence for complicated valuation models. We see a Wall Street analyst with a 50-tab Excel spreadsheet projecting a company's cash flows out to 10 decimal places for the next 30 years, and we assume that their conclusion must be more accurate and sophisticated than a simple analysis. We believe that if a concept is hard to understand, it must be more powerful. This bias prevents investors from appreciating the profound elegance of a simple, powerful idea. The concept of return on invested capital is not mathematically complex. It doesn't require a PhD in finance to calculate, but its explanatory power is immense. It cuts through the noise and gets to the heart of what makes a business successful. It answers the fundamental question: is this management team skilled at turning capital into profit? Investors who suffer from complexity bias will dismiss ROIC as being, quote, too simple. They will search for a more esoteric, more complicated metric, believing it holds the secret key. They will spend their time building intricate discounted cash flow, DCF models, with dozens of assumptions about future growth rates, margins, and terminal values. The irony is that the precision of these models is an illusion. A tiny change in one of the dozens of inputs can lead to a wildly different valuation. They are a classic example of false precision. The beauty of ROIC is its robustness. It is based on historical, audited data. It provides a clear picture of the company's demonstrated ability, not a speculative forecast of its future. By overcoming these two biases, by having the discipline to ignore the endless stream of noise and the courage to embrace a simple, powerful concept, you can dramatically improve your investment process. You can free yourself from the paralysis of information overload and the false comfort of complexity, and instead focus your energy on the one thing that truly drives long-term stock returns: the quality of the business. Now let's translate all of this into a practical, step-by-step guide for the retail investor. You do not need expensive financial software or a deep accounting background to get a powerful sense of a company's return on capital. You can do what we'll call the napkin math ROIC calculation. This is a simplified but highly effective way to quickly assess the quality of a business's engine. Step 1 is to find the company's net operating profit after tax, or NOPAT. This number represents the company's true, unlevered operating profit. The easiest way to estimate this is to go to the company's income statement and find the line for operating income, or EBIT, earnings before interest and taxes. Then, you need to find the company's effective tax rate. You can calculate this by taking income tax expense and dividing it by pre-tax income. Let's say the tax rate is 25%. You then multiply the operating income by 1, the tax rate. So, if operating income is $1 billion and the tax rate is 25%, your NOPAT is $1 billion times 0.75, which equals $750 million. This is the numerator of our ROIC formula. Step 2 is to find the company's invested capital. This number represents all the capital, from both debt holders and equity holders, that the company has used to build its operations. The simplest way to estimate this is to go to the balance sheet. Find total equity, also known as book value or shareholders' equity. Then find total debt. This includes both short-term and long-term debt. Add these two numbers together. Then, because cash is not operating capital, you should subtract the company's cash and cash equivalents. So if a company has $4 billion in total equity, $1 billion in total debt, and $500 million in cash, its invested capital is $4 billion plus $1 billion, $0.5 billion, which equals $4.5 billion. This is the denominator of our formula. Step 3 is the final, simple calculation. Divide your NOPAT by your invested capital. In our example, that would be $750 million divided by $4.5 billion, which equals approximately 16.7%. That is your ROIC. This number, 16.7%, is the return the company is generating on all the capital entrusted to its management. Step 4 is to put this number in context. Is 16.7% good? The general rule of thumb is that a company should be earning a return on its capital that is significantly higher than its cost of capital. The weighted average cost of capital, WACC, can be complex to calculate, but for a quick assessment, you can use a simple hurdle rate of 10%. If a company is consistently generating an ROIC above 15% or 20%, you are likely looking at a high-quality business with a competitive advantage. If its ROIC is consistently below 10%, it is likely a mediocre business that is not creating significant value for its shareholders. By performing this quick napkin math calculation on a handful of companies, you will begin to see the world in a new light. You will be able to instantly differentiate the capital-light compounding machines from the capital-intensive treadmills. This simple tool is your X-ray vision. The path of the 99% of investors is paved with an obsession over two of the most widely cited yet often misleading financial metrics: the earnings per share, EPS, and the price-to-earnings PE ratio. Every quarter, the financial world holds its breath for a company to beat or miss its consensus EPS estimate. This short-term focus creates a dangerous and distorted view of a business's true health and long-term potential. The problem with earnings per share is that it is an accounting number that can be easily manipulated. A company can boost its short-term EPS through a variety of tricks that do not create any real underlying value. They can cut back on necessary long-term investments like research and development or marketing, which will make the current quarter's profit look better but harm the company's future competitiveness. They can also use accounting gimmicks related to revenue recognition or expense timing. More insidiously, a company can grow its EPS simply by retaining earnings and reinvesting them, even if that reinvestment is at a very low rate of return. If a company retains $1 and invests it at a 5% return, its earnings will go up and its EPS will rise. The investor who only looks at EPS sees, quote, growth, but the investor who looks at ROIC sees that this growth is destroying value. The PE ratio, which is simply the stock price divided by the EPS, inherits all of these flaws. It is a snapshot valuation metric based on a potentially flawed and short-term focused number. A low PE ratio is often seen as a sign that a stock is, quote, cheap. But more often than not, a stock has a low PE ratio for a very good reason. It is often a signal that the market has correctly identified the business as being of low quality, with a low return on capital and poor future prospects. These are the classic value traps. The company looks cheap, but its intrinsic value is declining every year. Conversely, a company with a high PE ratio is often dismissed as being expensive, but a high PE ratio can be entirely justified if the company has a very high return on invested capital and a long runway of opportunities to reinvest its earnings at that high rate. The market is correctly pricing in the power of its long-term compounding engine. The obsession with these two metrics creates a frantic, short-term trading mentality. It encourages investors to buy and sell stocks based on whether a company met an arbitrary quarterly target that was set by Wall Street analysts. It completely ignores the more important questions. Does this business have a durable competitive advantage? How skilled is its management at allocating capital? And what is the return it is generating on its invested capital? By shifting your focus from the deceptive simplicity of EPS and PE to the profound insight of ROIC, you elevate your game from that of a speculator to that of a true business analyst and long-term investor. In your journey to become a more sophisticated analyst of businesses, there is one final crucial distinction you must understand. It is the difference between return on equity, ROE, and return on invested capital, ROIC. Many investors and even financial websites use these two metrics interchangeably, but they tell very different stories. Understanding the difference is key to avoiding a major analytical trap. Return on equity is calculated by taking a company's net income and dividing it by its shareholders' equity. It measures the return generated for the equity owners of the business. On the surface, this sounds very similar to ROIC. However, ROE has a critical flaw. It can be easily manipulated and artificially inflated through the use of debt, or what is known as financial leverage. Imagine two identical companies, Company A and Company B. Both generate $100 million in operating profit. Company A is financed entirely with $1 billion of equity and has no debt. Its ROE would be its profit divided by its equity, a respectable 10%. Now consider Company B. It is financed with only $200 million of equity and $800 million of debt on which it pays 5% interest. After paying $40 million in interest, $800 million asterisk 5%, its pre-tax profit is $60 million. After taxes, its net income might be around $45 million. Its ROE is that $45 million in net income divided by its tiny equity base of $200 million, which comes out to a whopping 22.5%. An investor who only looks at ROE would conclude that Company B is a far superior business. It has more than double the ROE of Company A. But this is an illusion created by financial engineering. The underlying operational profitability of both businesses is exactly the same. Company B simply juiced its returns for shareholders by taking on a massive amount of debt. This debt adds significant risk. If there is a slight downturn in the business, Company A with no debt will be fine. Company B, on the other hand, still has to make its interest payments. A small dip in profits could wipe out its earnings entirely and even push it towards bankruptcy. This is where ROIC reveals the truth. The calculation for ROIC includes both debt and equity in its denominator, the invested capital. For both Company A and Company B, the invested capital would be $1 billion, and the operating profit would be the same. Therefore, both companies would have the exact same return on invested capital. ROIC strips away the effects of leverage and shows you the pure, underlying profitability of the business operations. It tells you how good the company is at its actual business, not how good it is at borrowing money. When you are assessing management quality and the strength of a company's competitive moat, ROIC is the far superior metric. It provides a true, apples-to-apples comparison of operational excellence, regardless of how a company chooses to finance itself. It is the final piece of the analytical puzzle that separates the truly great businesses from the ones that are merely using debt to create a dangerous illusion of success. You have just completed a deep and intensive journey. You have moved beyond the surface-level noise of the stock market and have acquired the single most powerful analytical tool that Warren Buffett and the world's greatest investors use to identify true compounding machines. You now possess the X-ray vision to look inside any business and assess the quality of its economic engine. You can distinguish between the growth that creates value and the growth that destroys it. You understand that a company's ability to reinvest its profits at a high rate of return is the fundamental driver of all long-term wealth creation. This is not just theory. It is a practical, actionable mental model that will permanently change the way you look at investing and building wealth. You are now equipped to avoid the traps that ensnare 99% of investors. But mastering this single, powerful principle is only the first half of the equation. You have learned how to answer the crucial question of what to buy. But the art of building a legendary portfolio requires you to fuse this knowledge with the answer to an equally important question: when to buy. Identifying a wonderful business is one thing. Knowing what price to pay for it is another. How does this powerful concept of return on invested capital connect to the equally critical principle of a margin of safety? How do you value a business that is growing its earnings at 20% per year? Answering this is the final, crucial step. The video that is now appearing on your screen is the missing link. It is the bridge that connects the science of identifying quality with the art of disciplined valuation. It takes the powerful engine you have just learned to recognize and shows you how to buy it at a price that sets you up for explosive returns. The journey to becoming a master investor, to achieving true financial freedom, is a process of assembling a complete mental arsenal. You have just forged a powerful new weapon. The next piece of the map is right in front of you. Don't stop now. The choice to click is not just about watching another video, it is a commitment to continuing your ascent. It is a declaration that you will not settle for average returns or incomplete knowledge. Complete your arsenal. Click and continue the journey.